Blake Boss here, folks. Today we're going to be looking at YRC Worldwide and checking to see how much financial trouble this company is in. So as fellow fool Lalit Kumar pointed out, the less-than-truckload industry has been plagued by a pricing war since 2008, which has severely hurt YRC. YRC is currently pegged to go out of business. The recent share rally of around 80% suggests investors are betting the company may escape that fate, though. But don't hop on board just quite yet, folks. The company hasn't produced any free cash flow since 2008. Operations have been financed primarily by debt, which has led to a very large interest expense per year at the company of $150 million per year. The last 12 months, operating income needs to rise by 127% just to meet the interest obligation, to put that in perspective for you. The key detail investors really need to focus on if you're looking at YRC or you're currently an investor in the company is the company's cash balance. In order to meet loan covenant requirements on current debt, cash balances have to be around $119.4 million. If they flow below that mark, they'll be considered in default of their current obligations, and lenders can thereby accelerate payment obligations or go to collect on the loans currently outstanding. Generally, if this happens, the company will try to modify these loan covenants in certain circumstances to avoid the default, so it's not a sure bet that what lenders will do. Generally, the two counterparties want to work with each other as much as they can to avoid any default obligation. So long story short here, folks, YRC isn't making any money and most likely won't be able to issue any more debt. So that really leaves the company with only one option: issue more shares, more equity, dilute shareholders. The company hasn't had a big share issue quite yet, but this tact will negatively influence the stock price if they do have to issue shares, and should be seen as a last resort, last ditch effort by the company to stay afloat. YRC needs a shipping rate rebound though very soon. That's the big deal here on what investors should be focused on. Although I think their less leveraged competitors like FedEx, Old Dominion would love to see YRC bite the dust and go out of business, so they'd have better pricing power in this really cutthroat industry. I'll be sitting this one out, folks, especially since Old Dominion recently lowered pricing expectations for freight at their company, which should negatively influence the industry overall as pricing is concerned. That's all I have for you today, folks. Thanks for watching, and Fool on.